But, okay, the question was, we set the parities when we introduced the euro. So the euro is going to be worth so many French francs, so-called legacy rate, so many drachmas. How do we set those numbers? So we look at purchasing power parity, I mean, just like it's taught in the CFA exam. And of course, there are disagreements. Now, for Greece, for example, the idea was, really now they are not competitive. But, you know, after a couple of years of being in the euro, they will reform. They will be much more competitive. There's so many simple things to do. It's so easy to do. So in 5-year times, they'll be much more competitive. So if we set the legacy rate at today's level of competitiveness, we're going to have trouble in 5 years because they're going to be too strong. So they set the legacy rate at about 25% higher than in 1999, just to reflect the obvious future progress of Greece. So already Greece started with a 25% handicap in terms of inflation and productivity. Now let's see what happened. Germany, there has been inflation in Germany, but they did a lot of investment and productivity gain. So unit labor cost basically in nominal euros didn't move. They managed to make productivity gain to offset inflation. Well, you can see like Greece, somewhere here. Year after year after year, their situation deteriorated. So in 2011, they were about 35% less competitive, higher cost than Germany. Now you remember they started maybe already 20, so it's 20 plus 35. I mean, we're getting like a wide competitiveness disadvantage. And maybe you can see these countries like France. France has progressively gotten less and less competitive. 10 years ago, it was about as competitive as Germany. Now it's really getting quite bad. That shows the real aspect of the crisis. The disparity among Eurozone countries shows in the current account balance. Remember, like the international trade balance of each country? The data here is for 2010 because that was kind of the start of the crisis. Germany has a big surplus. The surplus is about 6% of German GDP. You can see the others here. Greece at the time had a 6.5% of GDP deficit. Spain, 5%. France was times 2%. These countries are not competitive compared to Germany. But they have the same exchange rate, so they cannot adjust the exchange rate to try to become more competitive. They are stuck with exactly the same dollar-euro exchange rate, whether you're Greek, German, or French. And the situation is getting worse and worse every year. Like France, the deficit has increased in 2011 and is ballooning in 2012. Same for Italy. Now, we all know, I mean, I'm sure Kenneth, we can use any statistics to say, you know, green or white or blue or black. So I was just reading this summer an article in Time, and I think, you know, it's more down to earth, but they said the same thing. A decade ago, France was more price competitive than Germany. Today is the other way around. I love asparagus. I know in China we don't eat too much asparagus, so we eat the small green one. But in Belgium, France, and Germany, we use the big kind of purple one, very different taste. Now these asparagus have to be in a hill of earth. They should never see the light. That's why they remain this very pale color. So it's a lot of work. I mean, you always have people, you know, putting more earth so they still get hidden from the light. And then you have to, you know, kind of bend down and cut them. It's very labor intensive. It's also seasonal, but very labor intensive. Actually, it's much, much more labor intensive than tomatoes or potatoes, because you cannot use engine. You have to cut every single asparagus. As they say here, 10 years ago, France and Germany produced the same amount of asparagus. Today, Germany produces 4 times more. Why? Because they both use seasonal labor. But in France, we have all these very inflexible laws. If you hire a seasonal worker, I mean, you need to do a contract, you need to pay social security for 6 months, health insurance for 6 months, you need to give vacation days, and then you cannot fire them. It's very complex. So now, as they say here in the article, German seasonal worker costs half as much. No more asparagus produced in France. This is not a monetary problem. This is a real economic problem. This was. Tracy, I need you. Yes, thank you. Oh, you better than Tracy. No, not better now. Okay. The other real aspect, and we talk so much about, are interest rates. This has been going on for now years, 2 years, I think. How can a country remain competitive if it borrows at 6%? I used to have 7 there, but I took it down to 6 since the ECB last week decided to announce that they would probably intervene somewhere or another. And so in the long term, interest rates now is 6% in Spain, 1.5% in Germany. Now these are numbers, but think about the amount of debt they have. Spain has about 100% of GDP in terms of debt capital. That includes the government plus the regions that people tend to forget a bit about. So make it simple. 100% of GDP is total amount of debt. 6% per year. That means that Spain is burning, inside the light, you just burn 6% of its GDP every year by paying interest rates, not reimbursing capital, just paying 6% of interest rate on its GDP. 6% of GDP, that's an enormous number. When your competitor, which is Germany, is only burning 1.5%. So let's assume it's like a 5% differential. Okay. Now, in China, we're used to growth rate of 10 or more percent, growth rate of GDP. Now we get down to 8, and people complain a lot. Now in Europe, we are more used to like 2%, 3% is good, 5% is unbelievable. Okay, so 5% is great. Spain would need 5% of growth to kind of offset this interest cost. 5% of GDP growth. We are not there. Okay, so every year is really losing wealth because right now it's in recession. So then you subtract 6%. Situation is really, in real economic term, untenable and very difficult. So our problems can be solved, and now I'm going to go quick. It's very obvious. The traditional way was devaluation and debt restructuring. Greeks would have devalued if it was in drachma. It would have defaulted on its debt, and then there would be more inflation domestically, and so domestic debt would also be devalued, and then we can start a clean. We can wipe out the lenders. But we cannot do that. It's Eurozone. I mean, the Zorros, the Supermen, don't want it. Default, which is what happened, without devaluation. This is amazing. They defaulted on debt and did basically nothing else. Okay. So that solves some past problems. That's bad for banks who hold the debt. But Greece is so small. I mean, it's just like a little cherry on the big cake. It's not a big problem. Well, once we get to Italy and Spain, that's going to be a different story. But it solved nothing. So we say, we want belt tightening and real structural solution. Anyone who has been to Spain or Greece know that the taxi drivers are kind of a union with a cartel monopoly and so on, the lawyers, everyone. So we tried to make changes. But you've seen what's happening in Europe. It's very difficult. The people get in the street. Politicians don't like to do it because it's very unpopular. And the benefits only will take place in 5 years or so. It will take time. Okay, you reform the taxi drivers, but when will we get the benefits? Structural problems are today, solutions are today, but then the benefits will be many years. There is no way. I think no government can survive this program. And people talk about austerity, but austerity is just one aspect of it. What is more difficult, it's not a question about spending, not spending. It's a question of reforming the labor market, reforming the rigidity in the economy to make it more competitive. And that is even more difficult. It's not just like signing a check or not signing a check. So non-pigs taxpayers keep financing pigs. But the situation is such that today it's mostly Germany and a few satellites that are financing. Yes, please, Tracy. So I like this. You see here the mountain, the debt, and on the right side here, this is me with my 2 grandchildren. This is serious. Next one, please. And problems will not be addressed, the structural problems, because politicians are politicians. I don't have politicians are politicians. Okay, they care about elections. They care about being popular. They are not very smart. They cannot take drastic measures that will bear fruits in 5 years because their election is in 6 months or 2 years. It's very painful. But I think past research has shown that brutal medicine is better than lingering sickness. So we go into those tricks. The ECB, the Euro bond, and so on. Now, I like this quote that I just read yesterday in The Guardian. Keep normal. There is renewed optimism that Greece would avoid leaving the Euro within the next year. Why? Well, Der Spiegel, which is a very famous German newspaper, say Angela Merkel has calculated that a disorderly Grexit, as they call it, would threaten her re-election bid in 2013. So yes, we're buying more time, maybe until 6 months. Oh, it's working? No. So I think the Eurozone, I'm looking at the implication now. I think the Eurozone will implode. The sooner the better. I was hoping they would have done it in 2010, 2011, 2012, I don't know. But remember that really people are paying trillions of dollars, or euros, the same, just to buy time. That's all it's doing. And that makes the problem more difficult to solve. Every month that passes, there are more billions, and that will make it more difficult to solve. What will happen to the exchange rate if I'm correct? Well, uncertainty is never good. So it's bad for the euro. The question is, will the strong countries retain the euros and the southern country leave it? Then it will appreciate. After a few months, it will appreciate because it's a strong currency based on fundamentals. But maybe Germany will be fed up with the other 17 or 16 or say a dozen of the countries, and then they will go back to the Deutschmark, and then the euro will be left for France, Italy, Spain, and then the euro will be weak. Financial market, bonds, I think it's a fascinating market now. I would love to be a bond trader. Especially if I gamble on the bank's money. But I think it's exciting. The problem is forecasting the triggers. What will be the trigger? The likely one would be the Constitutional Court in Germany makes a very nasty statement, which they want, but so people will try to interpret what this Constitutional Court says. There will be election. I don't know. I have no idea. I'm not a forecaster. Corporate bonds. Nowadays, corporate bonds of European companies are great compared to some sovereign risk.